Welcome to The Debate. You know, when you first learn to skydive, they don't just hand you a parachute, open the door of the plane, and wish you good luck,
Yeah, that would be a disaster.
right? They put you in a tandem harness. You are physically tethered to an instructor. The experience is thrilling, but your risk is structurally capped by the system itself.
I mean, sure, you have the illusion of total freedom while actually being completely protected from a catastrophic freefall.
Exactly. When you're tethered, your worst-case scenario is heavily mitigated. But you know, in retail options trading, a beginner can just open a brokerage app on their phone, tap a screen a few times, and theoretically take on infinite financial exposure.
Infinite. Yeah.
Right. We are looking at a market environment that is entirely unforgiving. So today we are exploring the really complex mechanics of options trading for retail investors who are just starting out.
Specifically focusing on that intersection of risk mechanics and trader psychology, because it's brutal.
It really is. So the central question we're tackling is this. When tailoring strategies for beginners, is it safer and more effective to strictly utilize long options, buying calls and puts, to absolutely cap their financial risk?
Or, and this is where I come in, does the structural advantage of short options, so selling premium, offer a better statistical risk-reward profile despite that theoretical infinite exposure?
Right. And this is all grounded right in our source material. We're looking at regulatory frameworks like FINRA, Rule 2360, Standard Brokerage Risk Guidelines,
And the harsh behavioral finance realities of how retail traders actually behave when, real money is on the line.
which is usually poorly.
Usually, yeah. It's a crucial discussion because how we onboard beginners usually determines whether they survive their first year in the market at all. I mean, my stance is that relying solely on long options sets beginners up for a death by 1,000 cuts.
And I completely disagree. I think long options are a necessary safeguard. The capped risk prevents catastrophic emotional errors. So let's just get into it. The reason regulators like FINRA take such a hardline stance here is purely structural. If we look at the Rule 2360 guidelines regarding account opening, supervisors are explicitly directed to restrict inexperienced investors to lower risk strategies, like long options.
Because they don't trust them.
Exactly. The rationale is incredibly straightforward. A retail trader's biggest enemy is their own psychology. We see it constantly in the data.
Oh, the revenge trading.
Revenge trading, emotional impulsivity, the desperate Hail Mary pass after a string of losses. When a beginner buys an option, the absolute worst-case scenario is mathematically locked to the premium paid. Period.
Right, but
Let me just finish this thought. That capped risk acts as a structural circuit breaker. It physically prevents a beginner from suffering a totally unlimited loss that could, quite literally, wipe out their account overnight while they're still learning how to control those baseline emotional impulses.
Okay, but that structural safety net comes at an enormous statistical cost. I mean, while short naked options absolutely carry theoretically unlimited risk, categorically pushing beginners toward long options ignores the punishing physics of the options market.
Punishing? How so?
You are forcing them to fight the Greeks from day one, specifically theta. I mean, long options are wasting assets.
Well, they're paying for insurance.
But to win on a long option, a beginner doesn't just need to be right about the market's direction. They have to be right about the direction, the exact timing of the move, and the magnitude of the move, just to overcome the break-even point.
True, but
Selling options, utilizing credit strategies when implied volatility is high, it aligns the beginner with market probabilities. It puts time decay on their side.
I'll grant you that the math of time decay is a headwind. But I want to look at how that actually plays out on the screen for a beginner who is, quite frankly, terrified of making a catastrophic mistake.
Okay, let's look at the screen.
Let's use a concrete example. The Micro E-mini S&P 500 futures options, which are highly popular right now. Say a beginner buys a March 39.10 call. The premium is quoting at 86.35 points.
Right, with a $5 multiplier.
Exactly. Because of that $5 multiplier, that translates to exactly $431.75. Their maximum risk is precisely that amount. They can go to sleep knowing they will not wake up owing the broker a single penny more.
Must be nice to sleep so soundly.
It is. That defined risk protects them from the surprise effect. Unexpected overnight market gaps driven by, I don't know, a geopolitical event or a sudden macroeconomic data drop.
But what are they actually paying for that peace of mind? The probability of that $431 expiring completely worthless is massive.
It's a calculated risk.
It's a bad bet. When you look at the option chain, if that call has a 16 delta, that isn't just a Greek letter to track hedging. It essentially tells you the market is pricing an 84% probability that the option expires out of the money.
Okay, but
Beginners suffer heavily from optimism bias. They constantly overestimate the likelihood of a massive directional move. They're convinced their technical analysis has uncovered a guaranteed breakout.
which is exactly why we limit their risk. I mean, if they suffer from optimism bias, letting them sell options means they will drastically underestimate the tail risk of a catastrophic loss.
That's a discipline issue, not a...
Listen, if a long option is a decaying insurance policy, a short option is underwriting that policy. You are stepping in as the insurance company. But a retail trader doesn't have the massive capital reserves of an institution to absorb a historic payout.
Right.
So how can we responsibly hand a beginner the keys to underwrite unlimited risk, knowing that one true black swan event could leave them actually owing their broker money? A margin call isn't just a trading loss, it is a legally binding debt.
I understand the fear of the black swan, I really do. But the reality of daily trading is much more insidious than a once-in-a-decade crash. The slow bleed of long options actually triggers the very behavioral traps you're trying to avoid by capping the risk.
The slow bleed is just the cost of admission.
No, it's torture. When a beginner buys a long option, they fall right into the trap of loss aversion and the endowment effect.
How so? I mean, because their loss is strictly bounded, I would argue, it reduces the ambient anxiety of the trade.
It doesn't reduce the anxiety, it just prolongs it. Think about the mechanics of theta. It isn't linear, right?
Right, it accelerates.
Exactly. As you get inside 30 days to expiration, that decay curve steepens dramatically. Every single day, the beginner logs in and watches their account tick down. Because of loss aversion, this psychological principle that humans feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain, they are in a state of constant distress.
Well, they should just sell if the thesis is wrong.
To overvalue the position simply because they hold it. They hold on to a rapidly decaying asset in the irrational, hope-fueled delusion that a sudden rally will bail them out.
Yeah, I've seen that happen.
They watch it bleed to absolute zero because they simply cannot formalize the loss by clicking sell to close.
Sure, watching an option decay is painful. And obviously, hope is a terrible trading strategy, but I'm not convinced that prolonged anxiety is worse than acute panic, because short options trigger an even more dangerous cognitive bias, the escalation of commitment.
Every trader struggles to admit they are wrong, regardless of the underlying strategy. It's human nature.
But the mechanics of a short option amplify that struggle to a fatal degree. Imagine a beginner sells a naked call on a volatile tech stock to collect a $200 premium. The market suddenly moves against them. The stock price starts surging.
Okay.
Because the risk is unbounded, their unrealized losses aren't ticking down slowly like theta. They are compounding rapidly. They're suddenly down $2,000. What the behavioral data from market psychologists shows is that traders in this exact position just freeze.
The deer in headlights.
Exactly. The cognitive dissonance is too loud. They refuse to exit the short call, convincing themselves the market is irrational, not them.
They average down instead of stopping out. It happens all the time.
Right, they escalate their commitment, they hold on, completely paralyzed, until the broker's risk management algorithm physically intervenes. A forced liquidation via a margin call takes the choice out of their hands entirely, and that results in catastrophic financial damage.
But you're conflating a lack of basic operational discipline with a flaw in the strategy itself. Escalation of commitment happens in cash equity positions too. I mean, if a trader refuses to use a stop loss or honor their invalidation point, they're going to fail no matter what.
Yeah, but a stop loss on a short option during a gap-up opening doesn't always protect you. If the stock closes at $100 on Friday and opens at $130 on Monday due to, say, buyout news, your stop loss becomes a market order at the open.
That's true.
The slippage is historic. The financial damage is done before the trader can even react.
True. Gap risk is absolutely real. But this is exactly why we teach the implementation of cognitive bias checklists and probabilistic thinking. We have to teach beginners that markets are probabilistic, not deterministic.
Which is a tough concept for beginners.
Very tough. But when you sell an option, you are operating with the mathematical edge of the variance risk premium. The implied volatility priced into options consistently overstates the actual realized volatility of the underlying asset over time.
In theory, yes.
In practice, too. That premium is your edge. If you strictly manage your trades, accept that a certain percentage will gap or lose, and cut them mechanically, you survive the variance. Accommodating bad discipline by forcing them into a mathematically disadvantaged strategy just guarantees failure over a slightly longer timeline.
I appreciate the mathematical purity of the variance risk premium. I really do. But a beginner just doesn't have the bankroll or the emotional detachment to survive the negative variance. Let's talk about the practical guardrails that can protect beginners, particularly regarding volatility.
Ah, yes, the Greeks.
If we look at the Fidelity text on the common options trading mistakes, mistake number 4 is ignoring volatility.
Absolutely critical. Implied volatility is the heartbeat of options pricing.
Right. And beginners generally don't understand IV at all. They look at the premium and the strike, and they just ignore the Vega exposure entirely.
If a beginner blindly follows the mantra to sell premium, and they sell options in a low IV environment, it is like selling hurricane insurance in Florida right after a decade of perfectly clear weather.
Yeah, picking up pennies in front of a steamroller. Exactly. The premiums you collect are incredibly cheap because the market is complacent, but the storm is structurally inevitable. When volatility eventually expands, the value of that short option explodes against them, even if the stock price barely moves. Long options, at the very least, protect them from the dangers of expanding volatility. If they buy a long option and IV spikes, the value of their contract actually increases.
I completely agree that ignoring IV is a massive error. Selling premium in the lowest percentile of historical volatility is a foolish misallocation of capital. No argument there.
Good.
But that mechanical reality works both ways, and this is exactly where beginners get slaughtered on the long side. If a beginner buys an option right before a major binary event, like an earnings report, they are setting themselves up for a devastating IV crush.
Because they are buying peak uncertainty.
Exactly. Why do premiums explode before earnings? Because market makers aren't stupid. They don't know if the report will gap the stock up 15% or down 15%, so they pump up the implied volatility to price in that massive unknown directional risk. The options become incredibly expensive.
Right.
Then the numbers hit the wire, the uncertainty vanishes instantly, and the IV collapses back to its mean. The beginner could be completely right about the direction of the stock. The stock goes exactly where they predicted. But because the IV collapsed, the value of their call option plummets.
It's brutal.
They were right, and they still lost half their capital. That outcome is incredibly damaging to a beginner's psyche because it breaks their understanding of cause and effect in the market. Selling options when IV is artificially inflated allows the beginner to benefit from that exact crush.
The mechanism of the IV crush is brutal, I'll definitely admit that. But bringing it back to the beginner's psychological capacity, how can they practically manage the stress of short-term, overnight exposure with theoretically unlimited risk?
By managing their sizing.
But let's look at the reality of holding a short option overnight or over a weekend. You are entirely exposed to macroeconomic news, central bank announcements, or global events that happen while the market is closed. How does that weekend gap risk not completely overwhelm a retail trader who lacks the institutional risk management software to dynamically hedge their portfolio delta?
Like I said, they manage it through strict, uncompromising position sizing. You don't need a multi-million-dollar institutional algorithm to do basic arithmetic.
Fair enough.
The golden rule is that you risk a highly controlled percentage of your total account value on any single underlying asset.
But wait, if the risk is technically unbounded onto short naked call, how can you precisely size for 1% of your account?
By scaling down the underlying vehicle itself. This is why products specifically designed for smaller accounts like the Micro E-minis we discussed earlier are revolutionary for retail traders. Because the micro contract is 1/10 the size of the standard contract, it allows a retail beginner to trade with incredible precision.
Right, so smaller bites.
Exactly. They aren't putting their whole life savings on the line to sell one contract. If a massive overnight gap occurs and it moves heavily against them, the absolute dollar amount of that loss is still manageable within the context of their total account equity.
It scales the tail risk down to a survivable metric.
Precisely, and we also teach them to heavily utilize defined risk spreads, like a vertical credit spread, which structurally caps the upside risk while still allowing them to be net short premium.
I'm very glad you brought up spreads, because that effectively bridges the gap between pure long and pure short positions. But returning to the pure naked positions, which is where the real systemic danger lies according to the regulatory frameworks, I'm simply not convinced that a beginner has the emotional fortitude to execute their plan when a short trade goes violently off the rails.
It takes time to build that fortitude.
But the surprise effect causes paralysis. Freezing with a short option means your losses compound exponentially. With a long option, freezing just means your option slowly decays to zero over a period of weeks. The maximum damage is contained to the initial outlay.
But the damage isn't just financial. It is deeply educational. If you only ever buy long options, you are learning to interact with the market with a permanent mathematical handicap. You are constantly fighting theta. You are constantly fighting the probability curve.
I think handicap is a strong word.
It's the right word. Look at historical price action. The market spends a vast majority of its time ranging, chopping sideways, or drifting slowly. It rarely trends aggressively. If you only buy long options, you require a strong, aggressive trend just to break even. You are sitting there watching your premium evaporate, hoping for a statistical anomaly.
I would argue it is better to be handicapped and alive in the market, preserving capital, than to be mathematically pure and totally bankrupt from a single black swan gap.
But they go bankrupt anyway, on the long side. That's the tragic irony here. The slow bleed empties the account just as surely as the single margin call. It just takes 6 months of frustration instead of 6 days of panic.
I don't know about that.
It's true. And during those 6 months, the beginner is internalizing terrible habits. They learn to swing for the fences. They learn the Hail Mary pass because they are constantly digging themselves out of a hole created by time decay.
Well, let me frame the learning curve a little differently then. If a beginner starts strictly with long options, yes, they will experience time decay. Yes, they will lose premium to theta and IV crush, but they are effectively paying tuition to the market in strictly controlled, predefined installments.
That's an expensive tuition.
But it's controlled. They are learning how gamma accelerates the price of an option near expiration, how delta tracks probability, and how theta decays their position, all inside a sandbox where the walls are high and structurally secure.
Okay.
Once they demonstrate they can control their emotional impulses, once they prove they don't revenge trade and that they can take a loss without escalating their commitment, then and only then should a broker clear them for short, undefined risk strategies.
I understand the logic of the sandbox, and, controlling the tuition costs makes sense in theory. But I argue that the sandbox teaches the wrong physics entirely.
The wrong physics.
Absolutely. If you want to learn to navigate the actual market, you have to understand that the options market is a premium selling environment. Institutions, market makers, the smart money, they are net sellers of premium. They are collecting the bid-ask spread and farming the time decay.
Generally speaking, yes.
So when you mandate that a beginner must strictly stay on the buy side, you are actively aligning them with the dumb money. You are teaching them to be the consumer rather than the casino.
Well, that implies that buying options can never be profitable or part of a sophisticated strategy, which we know from the data simply isn't true. An opening range breakout strategy, or capturing sudden violent intraday momentum, relies heavily on the convexity of long options.
Yes, for highly skilled intraday traders who are executing based on order flow, watching the volume-weighted average price, and exiting trades in a matter of minutes before theta can even register.
True.
But beginners buying long calls and holding them for 3 weeks hoping for an earnings miracle to overcome a 40% IV crush, that is a structurally losing game.
Well, when we step back and look at the whole board, based on this analysis, my stance remains anchored in the structural realities of human behavior. Long options undoubtedly suffer from the friction of time decay,
and they require a directional edge to overcome the premium paid.
Yep.
However, their strictly capped risk is a necessary non-negotiable safety net. Beginners are still mastering their own cognitive biases. They are learning to manage the visceral fear of an unrealized loss, the greed of a winning streak, and the dangerous illusion of control. Until those baseline emotional mechanics are thoroughly mastered, handing them the ability to underwrite theoretically unlimited risk is negligent.
And my position remains that while naked short options demand rigorous risk management to survive the tail events, categorically teaching beginners to only buy options subjects them to a severe statistical disadvantage.
It's a trade-off.
A bad one. It triggers prolonged loss aversion, encourages Hail Mary trading mentalities, and forces them to constantly fight the structural realities of time and volatility. Acknowledging and utilizing time decay and the variance risk premium by learning to collect credit is essential for building a sustainable long-term approach to the market.
Yet, despite our fundamentally different approaches to navigating the option chain, I think we've mapped out some incredibly vital areas of convergence here today.
Definitely.
Whether an investor starts by buying long options to structurally cap their downside or selling options to put mathematical probability on their side, the primary causes of failure remain absolutely universal.
Without question, the market doesn't care which side of the options contract you are on if you lack basic operational discipline.
Precisely. Trading without a clear, predefined invalidation point, lacking strict position sizing, like allocating way too much of your total account equity on a single directional thesis.
Which happens constantly.
Exactly. And falling victim to emotional impulses like FOMO and revenge trading will entirely destroy an account regardless of the underlying strategy.
And I think this underscores the immense value of understanding both sides of the transaction deeply. You cannot truly understand the risks and rewards of what you are buying until you understand the exact motivations and the Greeks of the person selling it to you across the spread.
Which leads us to a broader final thought. As listeners dig deeper into the source material and continue their education, they will discover that the market isn't just a binary choice between long and short.
Right? It's not black and white.
There are sophisticated combinations, like the vertical spreads we touched on earlier, or covered calls, that actually blend the benefits of both sides. You can define your maximum risk while simultaneously collecting premium and utilizing time decay.
The options market is multidimensional. It's not just about guessing the direction of price. It's about trading time and trading volatility. Exploring how those dimensions interact is where the real edge is found.
It brings us right back to our skydiving analogy. Whether you choose to jump tandem to feel the structural safety of the harness, or you decide to pack your own chute to deeply understand the mechanics of the fabric, the tension, and the wind, the gravity of the market remains exactly the same.
Well said.
The ground is coming up fast, and you need to know exactly when and how to pull the cord. Thank you for joining us as we explored these multiple perspectives. We leave it to you to form your own conclusion about how to approach your first options trades.